So we are seeing investors take advantage of reverse exchanges when they get that really good off-market deal. And that's one where they can maybe negotiate. They got some built-in equity into that purchase right up front. So reverse exchange is something we're seeing people take advantage of right now.
I'm curious on, today's market, right? We're seeing kind of an interest rate environment that's kind of rapidly going up, and maybe cap rates haven't necessarily risen as fast, right? Sellers still holding on to fixed rate loans. They're not necessarily wanting to trade for sellers who aren't necessarily lowering their price. And I'm curious if you're seeing that too, and what that means for someone who might be in a 1031, if they're going to be selling high and maybe putting themselves in a tough debt position.
Yeah, absolutely. We're seeing that in the marketplace. We haven't seen that capitulation that I think we all expect to happen to adjust to the higher rates. So there's a little bit of a standoff there. I think I'm seeing it beginning slowly. You're beginning to see the dam break a little bit where there's a little bit of flexibility. Sometimes it may not be on price. Maybe it's on terms, right? So the seller is going to offer some terms to help make that deal a little more attractive. But the point being, you do bring up a great point. If you sell into the market and now you as a buyer are going to have to actually pick up new debt at these higher rates, that can be a little challenging. One way that we've seen, and I'm sure you've seen this in the marketplace as well, is maybe somebody will actually, instead of selling first, they'll purchase before they sell. So they'll lock in, they'll find a really good off-market deal. And that seller says, I need to sell right away. And they'll do what's called a reverse exchange, right? They'll buy that asset today, and that gives them 6 months to sell their existing property. So we are seeing investors take advantage of reverse exchanges when they get that really good off-market deal. And that's one where they can maybe negotiate. They got some built-in equity into that purchase right up front. So reverse exchange is something we're seeing people take advantage of right now.
I'm curious on the reverse exchange because I've heard of it a lot. I just don't see it practiced a lot. And it seems like some of the challenges, Scott, is, hey, I need to have that down payment. I need to be, really, really wealthy and have extra cash and liquidity to be able to obtain that new loan at a new property, and then be able to sell the other one. So talk us through, some of those things, or help us overcome some of those false beliefs with the reverse exchange that maybe some people have out there.
Yeah. When we call it a reverse, let's just define what it is. Reverse is I'm going to buy the replacement property before I sell the existing one. So you purchase it, and now you have 180 days to sell your existing asset. But interestingly enough, when we call it a reverse, there really are two different ways to do a reverse exchange. There's one, what we call parking title on the replacement property. And so this is what we call an exchange last format. We're going to tie up that purchased property and close on it, but we're not going to actually do the exchange until we sell the relinquished property within 6 months. In that format, you may not need to come up with as much of the cash up front. If you can get the seller to maybe do a short-term seller carryback, say 6 months, you come up, purchase the property, they carry back a note. When you sell your existing property, what we call the relinquished property, you then take all that cash, you pay off the seller financing, and then can wrap up the exchange. The other thing you can do too is you can cross-collateralize. You can borrow from other assets. If you're an investor and you've got a really good equity position in an asset, you do some short-term financing. You refi it short-term, pull that equity out to do the reverse exchange. So, Brett, you alluded to it. When you do a reverse exchange, you're going to have to come up with some cash to close on that purchase, right? And if it's all tied up in your relinquished property, you're either going to have it sitting from another source or be able to borrow against another property to do it. So some people can't do a reverse exchange if they don't have that liquidity. But, keep in mind, you don't have to do, we call it a reverse. We can park title on that replacement property or the relinquished property, which is called the exchange first format. So there are a couple ways to do it. This is where you want to get on the phone with your tax advisor and a really good qualified intermediary, and then look at your situation, right? What are the terms of the purchase? Do we have a conventional loan? Are we trying to do all cash? Can we have a short-term seller carryback? That might open up some options in a reverse exchange.